Hey TMFG community, John Iaconetti here with Carlo Cancino. In today's episode of Ask TMFG, we're going to be discussing the market volatility we faced from 2022 into 2023. Remember, if you do enjoy the content, like, comment, and subscribe to the YouTube channel because we love doing these videos for you. In today's episode of Ask TMFG, we're taking a look into the market volatility we have faced through the end or throughout all of 2022 and into the beginning of 2023. Now, some people may think this is unprecedented or something that we are not accustomed to. Well, frankly, we've seen this before. So, Carlo, I'll hand it over to you and get us started.
Thanks, John. Yep. When we look at the last 3 years in the market, it can often be described as volatile, uncertain, or simply scary. But if we were to look way back at long-term results, then we should be looking at the last 3 years as normal. Why do we think this? Well, let's look at the distribution of the last 97 calendar years on the S&P 500. We're using the S&P 500 because it has the longest history of data that's been tracked. And we can track back all the way back to 1926. So as you can see on this chart, or they call it a histogram, there's been a random distribution of returns ranging from minus 50%, there was 1 year, and all the way to plus 50%, where there were 2 years. You can see the bulk or the majority of the years were between minus 10 and plus 40. When you see data like this, it gives you a sense of the distribution or the randomness of returns, but it doesn't really give you an indication of where markets will go in the future. If you were looking at this and trying to determine how markets were going to perform the next year, it'd essentially be a random draw of the last 97 years. Now, let's look at the next chart. Now, we're looking at big picture here, and we're honing in on the last 3 years. 2 were positive and 1 were negative. 2020 and 2021 were positive years. 2022 was negative. This isn't out of the ordinary to see in market performance. Although it feels like we're not getting anywhere, 2 good markets, 1 back, if we look at the last 97 years, 73% of the markets were positive. All of this being said, why do we think the last 3 years in the market are normal? Well, let's look at these statistics. What we're looking at on this chart are the annualized returns on the S&P 500 and annualized returns on the risk-free rate, or T-bills. And we've got the time ranges broken up into 3 ranges. From 1926 to 2019, the S&P 500 had an annualized return of approximately 10.2%. T-bills, or the risk-free rate, had an annualized return of about 3.3%. The difference between the two is that equity premium, or what you'd expect to be receiving by taking the risk going into the equity market. Now, let's look at from 2020 to 2022. The S&P 500 had an annualized return of about 7.6%, while the risk-free rate, or T-bills, was about 0.6%. The equity premium being around that 7% number. Now, let's take all of the years, 1926 all the way to 2022. The S&P had an annualized return of about 10.18%. T-bills had an annual rate of return of about 3.2%, giving the equity premium about 7%. Regardless of the short-term volatility or long-term performance in the market, the equity premium you get from being in the market was around the same at 7%. So, as you can see, whether it's short-term volatility or over the long term, equity premiums have a normalized rate of return of 7%. Stay invested, maintain your investment strategy, and don't let the emotions of the current volatility in the market make you make changes to your portfolio.
Thanks for that, Carlo. And just like you mentioned, right, not news to us. Markets are going to be volatile, whether it was from way back when in 1920 until today. We're going to deal with volatility in the markets as we go forward. But again, it's what we always prioritize and focus what we can control, right? There's always going to be different news headlines that are going to say that this time's different or this volatility is for this reason and markets won't rebound. Well, we've heard our fair share of news headlines over the past however many years, and still we continue to see that long-term trend of equity premiums being about 7%. So that we like to invest based on the facts, and there you have it. So, well, that's another episode of Ask TMFG for today. Remember, if you do enjoy the content, like, comment, and subscribe to the YouTube channel. Until next time, I'm John Iaconetti.
I'm Carlo Cancino.
And this has been Ask TMFG.